Hi, everyone. Thank you for joining me. I'm going to talk about an analysis I did on the stock market that revealed four patterns of stock market behavior that repeat over the decades. They have predictable ups and downs at roughly the same times each year. It's quite fascinating. I'm going to share what I did and what I learned here in simple terms. If you're interested in learning about my analysis more in depth, you're welcome to check out my Substack. There, I wrote an article describing what I did in detail with lots of graphics that illustrate my findings. I've included the link in the description. But now, let's get into it. Trying to understand the stock market can feel frustrating with all of its ups and downs that seem confusing and random, at least to me. So I thought it would be interesting to look at the stock market in a data-driven way to see if there are hidden patterns. That way, we can get some valuable insights into market movements and how market dynamics work in cycles. This is helpful because being able to anticipate trends can help investors capitalize on them with more precision. What did I do? Because I was curious about stock market patterns that repeat over time, I had to analyze historical stock market data. I downloaded 30 years of daily price data of the SPDR S&P 500 ETF Trust, or SPY for short, from January 3rd, 1994 through December 29th, 2023, using Yahoo Finance. SPY is an exchange-traded fund, or ETF, that tracks the performance of the S&P 500 index, a popular stock market index. The S&P 500 represents 500 big companies from different parts of the US economy. Due to the size and diversity of the S&P 500 companies, people follow the S&P 500 to understand market performance. For this reason, I thought analyzing the historical data of the SPY would be a good way to get a rough understanding of repeating market trends. Now that I had the data, I prepared it for analysis. I'm not going to get into what I did here. You can read about it in my linked Substack article if you're interested. But basically, the point of preparing the data is to put it in a form that is appropriate for analysis. It helps us get the most accurate and useful results. Now it was time to actually do the analysis. Because I was interested in stock market patterns that repeat over time, I was curious, are there some years that look like other years? Meaning, do some years have the same SPY price pattern? Do other years have different patterns? Can we group the years by these patterns to find overarching trends and structure that exist regardless of year? To figure this out, I performed what's known as a cluster analysis. Cluster analysis sorts items into different groups based on their similarities. Imagine a grocer has a basket of fruits and wants to group them by type. The grocer might put all the apples together, all the oranges together, and so on. In the same way, cluster analysis organizes data into groups. It's a way to find patterns in the data without knowing what those patterns are in advance. So it's a powerful technique to discover hidden patterns, structures, and relationships in data. In the stock market context, cluster analysis helps identify years with similar performance patterns. I didn't make any assumptions about what these patterns could be. I just let the clustering algorithm reveal the structures in the historical data with no supervision, meaning I didn't tell it explicitly what to look for and just let it do its thing and reveal the patterns, which is amazing. What did the cluster analysis reveal? Four distinct patterns that repeat. They are what I call bearish, flat, bullish, and very bullish. In the years with the bearish pattern, the market suffers a big drop. In the years with the flat pattern, the market makes big fluctuations with no clear direction. In the years with the bullish pattern, the market goes up, and in the years with the very bullish pattern, the market goes up a lot. Looking at the years that belong to the different groups, these results make intuitive sense. The bearish group includes 2001 and 2002, when the dot-com bubble burst, and 2008, the beginning of the financial crisis. Conversely, the very bullish group includes 1995 and 1997, when the dot-com bubble was inflating, 2009, the beginning of the bull market following the financial crisis, and 2021, the year of meme stock mania following the 2020 pandemic. Overall, these results are fascinating because the cluster analysis found these patterns on its own, and these patterns are clear and make sense. What's also fascinating is that these groups of years show cyclical patterns that repeat within each group. So, not only do we have market trends that repeat on the level of years that we just discussed, each individual year has market swings that occur at similar times of the year, depending on the group that the year belongs to. For example, for most of the bearish years, the market drop happens on or after roughly the end of July or beginning of August. So if we can predict a particular year is a bearish year, we can expect there's a good chance of a big drop happening in the fall. Another example is that most bullish years tend to exhibit gains after around the end of May. So if we can predict a particular year to be a bullish year, we can expect a good chance of the stock market going up after around the end of May. A final example is for in the flat bullish and very bullish years. They often drop around mid-October to mid-November and then have a big increase through the end of December. So if we can predict a particular year is a flat bullish or very bullish year, there's a good chance of a big stock market increase at the end of the year. So what does this all mean? What did we learn? Cluster analysis proves to be a promising approach to understanding stock market moves. It revealed 4 distinct patterns that repeat over decades, along with cyclical fluctuations. It's helpful because these results offer a starting point for navigating ever-shifting trends. And if investors can understand predictable market moves, they can make more informed decisions. Now, where do we go from here in terms of this analysis? What's top of mind for me is to expand the analysis to predict real-time market moves for actionable insights. This analysis used data from 1994 to 2023, which are complete years in the past. As of this recording, 2024 is currently in progress. It would be great to predict if 2024 will be bearish, flat, bullish, or very bullish as soon as possible. So in future work, I'll map 2024 to the historical data to figure out which group it belongs to. That way, we can gain insights on what's happening in 2024 as it unfolds in real time.